Hello, everyone. My name is Peter Mitchell. I am managing partner of Kingsgate Capital Partners, and welcome to Five by the Fire. Five by the Fire is a podcast series, and we are joined today by Atul Rustgi, managing partner of Accolade Partners, and Graeme Bibby, CIO of Partners Wealth Group and advisory board member of the Kingsgate Capital Partners team. Before I hand it over to Graeme and Atul, so thank you very much for joining us, everyone. I would first you'd like to just say a few words about Accolade Partners and the Kingsgate Capital Partners relationship. Firstly, thank you, Athol, for joining us all the way from Washington, D.C., and Graeme and I today as well. So, absolute pleasure and really looking forward to hearing part of the discussions. And secondly, this is more a point rather than a question. When it comes to Accolade Partners and our partnership with you and the team, I would have to say that Accolade is the most unique, interesting, and best performing manager we have ever seen in this space, let alone having the good fortune and pleasure to work with. So thank you, Athol, to you and you and your team. To that point, we certainly know from speaking with many of our clients in Australia, New Zealand, and even the broader APAC area during your last raise in 2023, which in many cases was their first time ever to meet you or even heard of Accolade Partners. But the feedback, and importantly, this was really interesting, that the feedback that being able to have access and invest in a firm like Accolade Partners actually helped them win new clients, which is certainly part of the reason why our team and our clients are super excited to hear you raising for your next fund. So that's all. It's a combination of questions and points, but listen, I'm going to hand it over to yourself and Graeme. So let's get into it.
Well, thank you very much for having me.
And thank you, Peter. Hi, everyone. My name is Graeme Bibby. I'm an advisory board member of Kingsgate Capital Partners. And today on the podcast series Five by the Fire, I'm sitting with Atul Rustgi, one of the founding partners of Accolade Partners. It's a Washington, D.C.-based top-performing venture capital and growth private equity business with a 25-year record across various strategies and vintages. So to kick off, Atul, I think a great question to start with is, can you tell our listeners, firstly, about yourself and Accolade Partners and what makes Accolade so unique?
Well, Graeme, nice to meet you, and thank you for having me on. So my name is Atul Rustgi. I'm one of the two managing partners here at Accolade, one of the 7 partners at the firm. We are a fund of funds. We're based in Washington, D.C. We've been around now almost 25 years. We invest across the private equity landscape from traditional venture capital to private equity growth, to even blockchain and crypto. We have over $6 billion of assets under management. Our LP base includes traditional institutions, endowments, foundations, but also extends to family offices, individuals, and wealth advisors. And our LPs are very much global in nature, from the US all the way to New Zealand. What I would say, really, something that we really pride ourselves on is we try to find areas of unique risk return opportunity. Even on the venture capital side, our approach is very different than a lot of our peers. With seed managers, we like to really back small funds that get high ownership in individual deals where they can get not just 3 to 5x net funds, but even 5x, 10x. We've even seen 20x in our portfolio. On the PE growth side, we are the biggest, I believe we're one of the biggest allocators globally, especially in the US, to PE growth. Similar on the blockchain side, we're one of the biggest, again, if not the biggest allocator globally to blockchain. And those two areas, particularly where we don't have a lot of competition, we don't see a lot of our peers doing, because within the PE growth side, we saw a unique opportunity where we could find managers that invest in companies that embody arguably the best of venture capital and the best of private equity and get great risk-adjusted returns. And even on the blockchain side, we found a unique risk-return opportunity where we can invest in an emerging technology at its basically inception, where we could get some outsized returns. So I think that really is a lot of our ethos, is to invest in areas where we find a unique risk-return opportunity. Equally so, we like backing emerging managers, Fund 1, Fund 2s. For a lot of institutions out there, they consider that too risky. We actually see the opposite of that, where there is some downside protection if you diligence these managers from a team, strategy, structure perspective. where you can get some of the outsized returns because they are fund one, fund twos. Furthermore, if you look at our fund structures, some of them charge, standard terms, but even other funds of ours, for example, don't even have a management fee. And we think that aligns us with our LPs, provides them downside protection. And I don't know of many firms, if any, that have a no fee product. So there are multiple elements where I feel really distinguish us. But more than anything, we like to be intellectually curious. We're comfortable being contrarian, and exploring places where most of our peers might find too risky or shy away from. And to date, we've been fortunate. It's led to us being ranked the number one fund of funds globally by some established kind of reporting companies. Consistently, top 5% performance among our peers, and we've had numerous, about 3 or 4 fund of funds in a row that have been above a 3x net. So very proud of that.
Thanks, Ethel. When we first met several years ago, you had some great referrals and validations from leading consultants and allocators across the globe. Accolade Partners was identified as the top performer within the VC and growth private equity PE space. Your last 4 funds alone have returned to investors between 3x and 5x net money. So my question is in 2 parts: is firstly, how do you define growth equity? And the second part is, what do you do? What differentiates Accolade and that your firm is able to perform the way that you do year after year and vintage after vintage?
Yeah. So growth equity, we also call private equity growth. First, I'll tell you what it's not. It is not late stage venture. A lot of people misconstrue it for late stage venture because a lot of venture firms have rebranded their late stage strategy as growth just because growth sounds better than late stage. Ours is more private equity. Like, these are typically companies under 5, maybe up to 10 million of revenue, bootstrap, meaning they never raise outside capital. The founder built it on their own blood, sweat, and tears. And these are beautiful companies. I mean, they're growing 30, 50+% a year, typically over 100% net retention, meaning existing customers buy more product next year than the year before, high gross margin products, primarily software, and profitable. Anywhere from break even. We've even had companies have upwards of 50% EBITDA margins. So in some respects, this is the best of venture and the best of private equity. You get the growth characteristics of venture, the 50+% growers, over 100% net retention, but you get the best of buyout where they have profitability and they like to sell in 3 to 5 years. So even within our own portfolio over the past 3 years, we've seen around 50 exits, average 5x return, average hold period less than 5 years. Because of that, the last 3 years have been 3 of the best 6 years we've ever had in terms of distributions to LPs, and last year ended up being, I believe, the second best year we ever had in terms of distribution. So yeah, that's how we define growth equity. It's somewhat off the radar because when you look at asset allocation models, you have a bucket for venture, you have a bucket for buyout. There is no bucket for growth equity or PE growth. That allows it to be under the radar. I mean, there are anywhere from 3,000 to 5,000 venture firms just in the US. When you look at growth equity or PE growth, no more than 50 to 100 institutional ones. So very much under the radar, but because of the lack of capital, the lack of eyeballs, you can get some really compelling returns. I mean, as I said, averaging close to 5x returns on individual deals over the past 3 years.
There's some really interesting things that you've brought out there, Ethel. I think, for some investors, they would look at the last of 3-5 years and certainly the bumps through post-COVID. And, for Accolade and Kingsgate, when we first talked about your past fund, Growth Fund 3, it was a great time for you to invest there, not for everyone. And people will ask, well, why now? Is it still a good time to invest in growth equity?
I mean, we think it's one of the more consistent and reliable and predictable parts of within private equity. And when you look in the US at all the, the count is there are about a little over 400,000 tech-related or tech-enabled services companies. The vast majority, almost 80-90% of those are under 30 million of enterprise value. And a lot of those are bootstrap companies, meaning they never raise outside capital. The beauty of that part of the market is, valuations don't move as much as, say, venture. During COVID, you saw valuations on the venture side go to 50 to 75 times revenues. In our PE growth equity side, they stayed in that 5 to 10x revenues level. And so and they're on top of that, there's just a supply and demand issue. Even though 80-90% of the companies are under 30 million of enterprise value, only 5% of the capital is focused there. So you have this huge supply of companies, little amount of capital. So valuations don't move much. What's nice is when these companies get to 20-25 million of revenue, it's a very acquisitive stage in the market, even today. And if you can sell anywhere from 1 to 500 million, there are a lot of acquirers out there. And that's what we've seen. So we still find it to be very attractive just because of the market dynamics where you have this huge supply of companies, very little capital at the low end, meaning good valuations, good multiples. And when then you get to, 20-25 million of revenue and you're getting to that 100+ million enterprise value, there are a lot of exit options. And that's continuing even today. And the other thing that's nice, it's a nice mix of both strategics and financial buyers making the acquisition. So this strategy is not reliant on IPOs. It's primarily just M&A exits. And again, great exit environment at that 100 to 500 level, even in today's time.
That's excellent. We've covered a lot of ground. And my last question is really about, well, going from now and into the future. So what can investors expect to see next? And the fundraising and deployment environment, what is that like? In particular, maybe some of the sectors that look interesting. Certainly deep in a number of sectors.
So the two areas we primarily focus on, the majority is enterprise software, and the balance is healthcare. Enterprise software it's a beautiful business model. These are high growth companies, high gross margin, high recurring revenue, and can be very profitable. And that historically has been our sweet spot and will continue to be going forward. The balance of the portfolio is in traditional like healthcare software, healthcare IT, healthcare services that embody a lot of the same characteristics in terms of growth rates and profitability. So for us, I think our goal is just to continue executing on the strategy that we've honed in on now over 25 years, being disciplined on passing on managers when they get too big, say around that 750 to $1 billion mark, and replenishing our pipeline with emerging managers at Fund 1, Fund 2, many of them under 100 million in size, where we're their biggest LP and their anchor. And just continue to execute on what we've done because it's worked. And even this upcoming year, we're projecting a number of pretty big liquidity events from this strategy. So don't fix what's not broken. And so far, we're kind of in that phase right now.
Thank you for that, Atul, and for your time, and thanks everyone for listening. As I mentioned earlier, we've covered a lot of ground, not only about the growth equity space, but the current opportunities that are available to deploy into the market with Accolade. How you've been able to remain one of the world's premier investment managers in this space for over 25 years is truly impressive. And I speak for everyone on behalf of Kingsgate Capital Partners and the team and listeners. I thoroughly enjoyed today's conversation. Again, I enjoy these conversations with you, and we look forward to hearing more from you and your upcoming trip to Australia and the environment for fundraising and deployment.
Thank you very much for having me.
Thank you.